I just can't believe that interest rate. You said 17%, Ren. So you're telling me I can buy USDE and stake it and earn 3 times the amount as doing an under collateralized loan as a lender in an emerging market? Like that is, you're on crack. Like under collateralized lending on chain is a great business for borrowers and borrowers only. Like you're insane to be lending on those things.
Before we get into today's episode, just a quick disclaimer. The views expressed on this podcast by either myself or any guest are their personal views and do not represent the views of any associated organization. Nothing in this episode should be construed or relied upon as financial, technical, tax, legal, or other advice. All right, let's jump into the episode.
What's up, everyone? Welcome back to another episode of 0x Research. The Blockworks research team is back to bring you another analyst roundtable, this time joined by Brick and Matt from the Blockworks research team. Today is Monday, April 8th. And as always, you can use code 0xresearch10 at app.blockworksresearch.com at checkout for 10% off your annual subscription. Ren, do you want to kick us off with some news and governance updates?
For sure. Thank you, Sam. First of all, happy Eclipse Day to those who get the pleasure of doing the eclipse today. Starting off the news and governance updates. First of all, we have a proposal to enable Arbitrum Stylus on Arbitrum 1 and Nova. For those that need a refresher, Arbitrum Stylus basically allows developers to build on Arbitrum using languages such as Rust, C, C++, and so that sort of removes the smart contract development constraints of purely using Solidity that most EVMs or base blockchains have in the past. In addition, there's some sort of LTIP and STIP snapshots going on right now. On other news, we have a bunch of deployments. PancakeSwap will be deploying on Monad. PancakeSwap is probably live on 11 or so chains today. It'll be interesting to see what devs deploy on Monad given this sort of like performance and parallelization, and if there's any sort of like anything else that they need to change for the devs if they are deploying on there. Velodrome is going to launch its DEX on Build on Bitcoin, which is a Bitcoin L2 with EVM compatibility. I think that one will be interesting to see how many of these Ethereum devs try to hop on into sort of like the Bitcoin L2 ecosystem. I'll take a pause there, but any thoughts between Arbitrum Stylus, PancakeSwap, and Velodrome launching on this Bitcoin L2?
Yeah, I want to lean into Arbitrum Stylus. It's super interesting to me that it largely gets overlooked. Like, no one really cares about Stylus. Sure, you see a couple tweets about it, but no one really gives it any more thought than just, a fleeting thought. But Arbitrum Stylus is a pretty big deal. It pretty much allows any Rust, C++, or C developer to go code smart contracts on Arbitrum. And then additionally, they're composable with Solidity smart contracts. So you can have apps written in either language. So when you look at Monad, which is, also doing innovation in the virtual machine realm, it gets so much buzz and hype, and VCs are all over it, and it's got a narrative on Twitter. And Stylus just doesn't see it, and it doesn't make much sense to me. And also, I want to lean into the LTIP stuff a little bit, but I guess I'll give everyone a second in case you guys have thoughts on Stylus.
Keep ripping while you're cooking.
Yeah, so LTIP is allocating a ridiculous amount of capital to protocols as incentives on Arbitrum. And once again, I think it's overlooked. Like when STIP happened the last time there was Arbitrum DAO gave incentives to protocols, it took weeks for people to really realize, oh, shoot, there's a, $500,000 or $5 million FDV crypto token that's getting half of its FDV in incentives. So I do think that it's actually a place that there could be some alpha or some edge found for those that are, looking through which protocols were actually funded as a part of this LTIP process.
Generally speaking, Matt, how would you say the STIP went? Were any of the learnings from that implemented into the LTIP? And on top of that, is there any protocols that are receiving the LTIP that are particularly interesting from your perspective?
Yeah, so STIP is a tough one to evaluate. If you look at it purely from a fundamental basis of like how much money was spent versus the transaction sequencer, the sequencer fees from transactions, you could probably go ahead and say that it was a failure. But I think that that's really a misnomer because a lot of protocols who wouldn't have otherwise came over to Arbitrum are like, oh shoot, I want to be a part of this, incentives process. I want some incentives from the Arbitrum DAO. So we're actually seeing quite a few builders come into the Arbitrum ecosystem. For example, even though Synthetics was not funded as part of the LTIP process, they were largely interested in becoming a Arbitrum focused, or at least having some focus on the Arbitrum ecosystem. And we see this over and over again with other protocols. So I think from that perspective, STIP could actually be considered a win for the DAO and the Arbitrum ecosystem. I don't want to give any like financial advice, so I would just go say look through the Arbitrum forum post at which protocols got funded, and do your own analysis there.
On the front of Velodrome launching a DEX on Build on Bitcoin, I find that super interesting because the Solidity flywheel, like solidly flywheel, not Solidity, has like actually kind of started to take off. Like we didn't see anything because they launched in the kind of the peak of the bull, like beginning of the bear. So it was like honestly the worst possible time for a solidly type protocol to launch. So it's kind of cool to see Velodrome and Aerodrome like trading at all-time highs, generating all-time highs of fee revenue, and seeing the most volume they've ever seen. So I think this is like a really good time, especially with the launch of runes here around the halving for Velodrome to be going over there. I'm not sure if there'll actually be partaking in the runes protocol or not. I'm kind of confused as to actually what they're building on Build on Bitcoin, which is Bob, I think is what people refer to it as. But nevertheless, I'll be watching that one.
I think another interesting point about Velodrome is obviously they launch a new token, Arrow, for Aerodrome on base. It will be interesting to see if they also decide to launch a new token for their DEX on Build on Bitcoin. My gut feeling says no. At some point, like you can't just keep on launching new tokens for every chain you launch them, but I don't know. Seems to have worked out for Aerodrome pretty well. So that remains to be seen. A few other news and governance. Oh, sorry, Vic. Go ahead.
No, I was just gonna ask, aren't aerodrome incentives also front loaded, or like there's more dilution in the beginning, which is interesting if like the token wasn't doing that great in the beginning and now it has still like rebounded out of the um like not in a perpetual downwards movement, but really like starting to take off. So maybe this could be another curve like project where even though incentives are all the time coming in, they could still like manage fairly well.
Yeah, I believe the first 14 weeks you saw inflation gradually increase, or not even gradually, like pretty aggressively. And then from the 14-week period onwards, it like decays pretty gradually. So I think inflation is actually at the point to where it's going down now. But that being said, like there is just inherently a lot of token inflation that gets baked into these protocols. So like I definitely wouldn't want to be holding Velo or Arrow like in the beginning of a bear market, if that makes sense.
Yeah, definitely reflexive, both on the way up and on the way down. A few news updates on the airdrop front. Tensor season 4 started today. The claim is open. You can go claim and sell if you want your tokens. I think so far mixed reactions. There's some to be like some people that traded like a huge amount of volume and they were like whales who like didn't get as much as they would have thought, and a lot of people who like didn't trade much and got more than they thought. So it does seem like they utilize like some form of tier system. Perhaps like it wasn't as tiered as like something like Jito, where like there were separate tiers with like a fixed amount of tensor for each tier. But it does seem like there was some sort of tier. Currently, the token's trading at around 1.8 billion FTV, and that's in comparison to Blast at 1.5 roughly. Sorry, Blur at 1.5 roughly billion FTV. You can form your own conclusion as to whether you think like the Solana NFT marketplace should be worth more than the Ethereum sort of like gold standard NFT marketplace. But just one interesting point of comparison is Uniswap and Jupiter. Uniswap currently trades at a 11.6 billion FTV, and Jupiter trades at a 14.3 billion FTV. So make of that what you will. Something else on the airdrop side of things, DeepBook, which is a central limit order book protocol on SUI, introduced their native token Deep through a soulbound NFT. The token isn't live yet, but so far it looks pretty good. And I think that protocol actually does like a lot of like volume in the grand scheme of things. Sure, like a lot of protocols on SUI do have a lot of incentives just from the SUI Foundation. I think like just every week, like all of these protocols get like $500,000 or something ridiculous, but still. It'll be interesting to see what this is like the first big airdrop on SUI, given that I don't think there's been like a large one so far. Any thoughts on those like two airdrops?
Yeah, I mean, it's always hard to do airdrop, but especially following like the Jido thing where a lot of people suddenly got a lot of money compared to like how much they have put in. So I guess it always becomes like a trade-off between, do you want to incentivize kind of everybody or those who have really, really used the project? And if you go with the latter option, you're always going to run into the problem of like airdrop farmers who are going to get a big chunk of the like incentive structure. So my like kind of small thesis I've been thinking about is that this is something that we will probably, or like incentive structures or airdrop structures overall are probably something that we're going to be seeing a lot of developments in, or at least like projects trying out some new stuff here and there going forward.
Yeah, the Tensor one's tough for me to digest. Just obviously, it came like a couple hours ago, so I haven't had a ton of time to think about it. But NFTs have kind of been down only, and from what I'm hearing, like people were farming, season one. It was like the end of 2022, I believe. So like, if you were farming this thing at the end of 2022, you probably got absolutely slaughtered on the NFTs that you purchased for starters. And then they didn't even heavily weight the season one and season two activity versus season three. So the people who came in post Jido airdrop. And then you compare that to the FDV of Blur, which is obviously the de facto NFT marketplace on Ethereum, and it's trading at a premium to it. It just makes it a tough sell for me. And on top of that, like the proliferation of meme coins, like it feels like it's just totally replaced the attention economy on its Solana from JPEGs to meme coins. And I don't know if I see that changing, to be honest. And you even look at Magic Eden's market share on Solana. I haven't looked at it recently, but you would think that Tensor would have commanded like a 95% plus market share over Solana volume, considering it was pre-token. And granted, Magic Eden is pre-token as well, but you still see them with like 30 to 40% market share a lot of the time last time I had checked. So I don't know. I don't know if I would be buying Tensor is I guess what I'm saying, but obviously not financial advice.
Yeah, but I mean, I think that's a good example of, or showcases well how strong ordinals have been recently. Like a lot of people want to trade those, and then I'm guessing that okay, I traded ordinals on this platform. Let me as well just like trade my Solana NFT here. It's like there's a lot of stickiness there, and as I think I mentioned earlier on an earlier podcast, that it was a brilliant like business move from Magic Eden to like push into this narrative and grow through that.
Yeah, that statistics that you mentioned, Sam, is a little shocking to me, to be honest. I would have thought like Tenza would be like comfortably like above 80% market share on Solana all the time. But yeah, as Vic mentioned, I do think that could be strongly attributed to sort of like Magic Eden's command over like the Ordinals marketplace, and then that set of NFT traders flowing onto like other ecosystems.
Yeah, you also, just to mention real quick before you move on to the next note here, like you can download their wallet and that gets you like extra points for Magic Eden. So like I think that like Break, you nailed it on the head. Like people download the wallet, they use it, and like they're like, well, I might as well trade Solana NFTs here because I'm getting Magic Eden points as well on top of my Ordinals wallet.
It also feels that the like Tensor hype kind of died down, or I remember it had to be beginning of the year when Twitter was full of people like coming up with different strategies and just like trying to get as many points as possible. And then lately it has more been like nobody really talks about that platform anymore.
All right, a few last news updates. Ellipsis Labs, founder of Phoenix Trade, which is a crankless decentralized limit order book exchange on Solana, raised 20 million last week. And the last news update is that Antonio from dYdX said that dYdX V4 will introduce permissionless smart contract support, which will enable powerful opportunities for AMMs, vaults, structured products, asset issuance, and a lot more to be built on top of dYdX. Any thoughts there?
Yeah, I think the permissionless contract support on dYdX is particularly interesting. The way I see it, likely they want to enable, a traditional DEX for swapping and a lending market. And then you could see a world where someone could build something very similar to Ethena fully on chain on dYdX chain, meaning, a delta neutral stablecoin or something of that nature. So basically give traders all the infrastructure necessary to do delta neutral basis trading on dYdX chain. So I think that that's really, really cool. And I'll definitely be keeping an eye there to see if any projects actually go and build kind of what I have envisioned. Then there was also that interesting dYdX proposal that just passed to, I believe it was stake a portion of the treasury. I forgot the exact amount, to dYdX validators who were underrepresented. So to like smaller dYdX validators to help ensure decentralization of the network and its robustness. So I thought that was a really cool proposal as well. So not only, increasing decentralization to dYdX, but also, getting some yield in USDC to the dYdX treasury.
It's actually in that was a proposal by Stride. So it's 20 million from the community treasury, and they auto compound the USDC rewards back into dYdX. So it's actually like a cheeky little value accrual opportunity that they capitalized on for the dYdX token, which I thought was pretty cool.
But yeah, going back to the permissionless deployments, that's a pretty interesting business move, because if you look at something like Osmosis, they also allow uploading smart contracts on their chain, but it's permission, so like the community has to vote on it, which I kind of think makes sense, because then that doesn't allow for anybody to like spam the chain with some like basically trashed smart contracts or whatever. But I do see the like value in being permissionless, or like the crypto ethers. And it's also a like hard business model to get right, because for the underlying chain itself, it's like quite tempting, I guess, to start scaling vertically into the same like businesses as the smart contracts or the new projects deployed on top of the chain are. So like, for example, on Osmosis, there are already like perp platforms, but I think there would be a big incentive for Osmosis to like integrate perp trading into the chain itself, because it's or like the protocol or the project would allow perp trading itself, because it's a like great value accrual like possibility. But then again, like you're basically disincentivizing anybody else to start building on the chain.
I feel like dYdX has always had this vision though of just perps trading. Like dYdX is one of those teams that I have to commend on. They've had this vision their entire time. Like we want to be a order book centralized exchange user experience on chain. So we want to compete with Binance on chain just for perps. So I actually think that, even if they see some DEX or lending platform or something do a ton of volume and have a great value accrual model, they'll actually just stick with their vision. Like they've never strayed from it thus far. And I don't think they'll start doing that today.
I think there's some really interesting things you could do too with like cross margin. Like obviously, dYdX is a cross margin exchange. So like it'd be kind of cool if you could use your perps position as collateral on an AMM or a structured product or vault or some sort of thing like that. I don't know if that would get a little bit too messy and potentially introduce new risk into the system, but it'd be cool to see some of that come to fruition.
Big Infinity Pooh's throwback. RIP. All right. Now for a quick word from Axelar. Thanks to our fantastic sponsor, dYdX. All right, guys. For today's dYdX segment, we have your host, Axelar co-founder and director of the Axelar Foundation. Thank you so much for coming on.
Thanks so much for having me.
Just for quick starters, do you mind just giving us like a quick 30 to 60 second overview of what Axelar is?
Absolutely. So Axelar, the way we like people to think about it is that it solves the bridging problem, but it's not actually a bridge, right? All of you are familiar with bridges and all of the hacks over the past few years. Axelar operates one layer below. It is infrastructure. It is a platform that allows bridges and other applications to build on top, right? So to make an analogy, the same way that on a layer one, you can build decentralized exchanges, money markets, NFT marketplaces, all those great primitives. With Axelar, you can build chain-agnostic versions of those applications, right? A cross-chain DEX, cross-chain money market, cross-chain NFT marketplace, right? So it's a platform that powers bridges, but all kinds of other applications as well.
So we had Squidrooter on actually a week or two ago. How are you guys related to them in the wider dYdX ecosystem?
Great question. So Squid is one of these core primitives building on top of Axelar, right? And is the most popular cross-chain decentralized exchange that's built on Axelar. What it enables users to do is take an asset, say BNB on the Binance Smart Chain, and swap into USDC on dYdX. As simple as that, right? A simple interface looks very similar to Uniswap, but takes an asset as input on one chain and gives you an asset on another chain. Now, for the particular use case of dYdX, all of the collateral is in USDC, so that's the asset it delivers to the user. And the other cool feature that it has is that it can do the whole flow in 20 seconds. We have what we call these express features with Axelar, which allows applications to express their transactions. And we have these relayer services that take the whole risk on behalf of the user. So the user can actually get very seamless user experience, get their assets very fast on the destination chain, while assuming zero risk. You have this kind of market making entities, that's one way to think of them, that support the user and take a very small fee in exchange for the service.
Gotcha. I appreciate that explanation. And I know Axelar has a lot of exciting plans over the coming year, so would love to hear what's on the Axelar roadmap for the next 6 to 12 months.
Sounds great. Sounds great. So we're onboarding many of the non-EVM chains. Right now, Axelar has just EVM and Cosmos chains, about 60 chains integrated to the network. But we have a big upgrade that's going to launch smart contracts on top of Axelar and make connections permissionless. So we're going to be adding Solana, SUI, Stellar, Ripple, and a couple of other non-EVMs in the coming months. Now, usually when we decide that we want to add a chain, the decision is informed by the customers, right? The applications built in on top of Axelar. And a big segment that we're focusing on is real-world asset tokenization. A lot of the real-world assets issuers want to be launching on Solana because Solana has clearance from some regulatory bodies. In New York, there's only Solana and Ethereum. They also want to be launching on SUI because that's a new ecosystem. There's a lot of excitement there, a lot of opportunity for new stablecoin issuers. So I guess given how close we are with a lot of these real-world asset companies, we are prioritizing some of the non-EVM chains that they want. And we have a lot of very interesting initiatives we're going to be announcing in the coming weeks and months on the real-world asset side, and also the work we're doing with financial institutions. That's going to be a big part of what's to come with Axelar.
Nice. Well, that is super exciting, and we'll actually have to get you on for a full episode at some point to get a bigger rundown of Axelar, because I know there's a lot of nuances. But thank you so much for coming on. I don't know if you want to share with people where they can learn more about Axelar or where they can find you personally.
Yeah, for me, just follow me on Twitter. Feel free to message me. I always respond to people. Just type my name on Twitter, and happy to send you more information about Axelar. But I think just follow us on Twitter. We post regular updates, so you'll be able to find all of the information there.
Awesome. Thank you so much. We'll catch you sometime in the future.
Absolutely. Thank you so much for having me.
Now, moving on to our hot seat Kutzone segment. I'm going to throw it over to you, Sam, this week for probably one of the more talked about topics in the past week.
Yeah, I got a LARP as a Solana expert here for a second, but basically anyone who has used Solana over the past week or two has definitely realized it is incredibly broken. It's hard to land any transaction without submitting a request like 3, 4, 5 times. And Nishil on Twitter, we can be sure to link to this thread in the show notes, but put together a great explainer of really what's going on here. So I'm going to do my best to summarize it for you. So basically there's 3 paths for a given transaction on Solana. Either 1, it's successfully included and there's 0 errors, so the transaction went through and it was executed successfully. That's like the happy case. But then there's 2 where the execution actually failed, so the gas is paid, but the execution failed because of some certain unmet conditions. So like, for example, if you have too low of slippage set on an illiquid DEX pair, there's a chance that transaction actually reverts because the slippage tolerance was set too low. And that's actually the chart that's been floating around on Twitter that shows like 75% of Solana transactions have failed. That's the reason. It's mostly arbitrage bots who are spamming the network to some degree in order to get their arb through, because transaction fees are so cheap that you stand to make more on the actual arbitrage, assuming it's successful, and you can afford those failed transactions. So that's not really the problem here. The problem is actually the third case, which is drop transactions. And this is the case in which the block leader actually never even saw the transaction request by the user. So the networking layer is basically the communication layer of the internet, and it's used to send packets from one data connection to another. So, for example, TCP. And then there's Quick, which was actually designed by Google, which I found interesting in this thread. But basically, Solana uses Quick, and it gives the builders the ability to drop transactions based on certain criteria in order to combat chain halts during periods of high demand. And if you'll recall, Solana doesn't have a mempool, so losing connection here means that the transaction never actually makes it to the leader. So the problem is that even though block leaders can now like throttle certain connections, the logic on which the connections are throttled, like the criteria that need to be met, are really like poorly implemented and buggy. So it's just not well defined, and it's a poor implementation of Quick. So that's essentially what all the Solana developers are kind of all hands on deck trying to solve right now. But for the immediate term, it's not clear if any sort of patch or fix will actually solve the problem in totality. Fire Dancer is, of course, being worked on, which is supposed to address some of these quick implementation problems, but that's still 6+ months out. So it's really unclear as to when these issues actually get resolved. So I'll stop there. I don't know if you guys have any good takes on the poor Solana performance, but I guess it's a good problem to have is kind of my take. It means you're doing something right.
Yeah, I studied distributed systems engineering over the weekend, and so I'm now like a PhD in network engineering. From what I heard, I'm kidding. I'm not gonna pretend to know that much about like the networking layer of Solana, but I think there's like two ways you can like sort of fix this, right? One is like fixing the networking layer, and there's like a bunch of like optimizations that a bunch of teams, including like Anza, which is kind of like a spun out like team from the Solana Foundation or labs, are working on like the client. They're working on like fixes to like the networking component, but the other side of this equation is also like the fee market, right? Traditionally, Solana has struggled with fee market design. Their base fee is still like a fixed fee per signature, and it doesn't take into account the number of compute units that a transaction utilizes. And so there is like quite a large incentive for these arbitrage bots to spam the network at a relatively low cost. And so I think the eventual fix for this is both a combination of fixes to the networking layer and also fixes to the sort of fee mechanism. And I know like a lot of people are hyped about 1.18 and sort of like the new scheduler that's coming out, but I don't think that's going to help this or like help what Solana is experiencing that much, because that's at the point where the transactions like actually reach the block leader. Um, but right now, like the transactions aren't even reaching the block leader because of these like network and like propagation issues. So yeah, I don't know when it will get fixed, but not gonna lie, Solana like does feel pretty unusable. I think most people have to like do transactions like 3 to 4 times, and that's just like a pretty bad user experience. So between that or like $100 like transaction fees on Ethereum, just pick your poison, I guess.
The only thing that I think is worth noting is that just 3 years ago, pre-EIP 1559, Ethereum had similar issues, or at least a similar user experience, similar negative user experience. And instead of it taking like whatever, a few seconds for your transaction to drop and not go through, it was like tens of minutes or 10 minutes. So, while it's not good, it's a bad user experience. Anyone who's been on chain for 5+ years, this is something that will likely be solved in the future and get better, and it's definitely not the worst we've dealt with. So I guess what I'm trying to say is that having these problems now feels so much better than the problems we had just in 2020, which wasn't even that long ago.
What still isn't clear to me, and I hope one of you guys has some clarification here, is how the ore mining actually plays into these problems. Because, like, from my understanding, is it's not the arbitrage bots that are causing the problem; it's other stuff. And it's like, is ore mining really what ignited this, or is that not really that big of a part of the problem?
Should we maybe give some background on ore mining?
Yeah. So basically, there's like a proof of work ripoff that's like an application on or a smart contract on Solana, and you can run this program to mine these ores. And there's like very little liquidity. There's only like 100K of liquidity. Actually, that was like a week ago when I looked. It's probably like half that now. But regardless, you can mine these ores that have no real function. And apparently, that's been contributing to Solana's problems. But I truly don't understand why.
I mean, This is all coming from Daniel, our great teammate, who tried to explain this to me one morning. So I'm probably paraphrasing in a wrong way, but like he said that there's like a big incentive to just like spin out nodes or trying to get as much compute through to the chain as possible or through the smart contract, which like emits these ores when you solve the equation basically. So what people are doing are they are, for example, hiring some like professional RPC providers, I think, and then basically have them spam the smart contract on chain, which then I don't know how big the effect really is on the like bad experience, but apparently that could like bring about some problems.
I would have to imagine that these problems existed before or, and I think like even before or, right? Like there were periods where Solana was like slightly unusable. I don't think or like contributed that much to what you're seeing right now, but it definitely like didn't help. And as far as like the RPC front, Vic, I just thinking like on one hand, Mert must be like crying at how unusable Solana is, but on the other hand, this guy must be printing off his like RPC business.
I think it's just congestion in general. So like I'm sure ore mining has some contributes a bit, but so does Pump.Fun, so does meme coin trading, so does everything else going on Solana. And I think it's just back to like Ren's point that, you know, basically there's this incentive to spam the network to get your transaction in. Like if you have an opportunity to make, you know, $10, I don't even know how many Solana transactions you can spam to make that still worthwhile, but it's a shit ton. But yeah, I'm definitely not the most well read on the situation either.
Actually, that's an interesting point. You'd think it's like a snowballing effect where suddenly it gets a bit worse and then more people start spamming the chain and then more people start spamming the chain. So the like experience gets worse and worse. Kind of a self-feeding problem.
Yeah, the ore problem would be more interesting if the price was going up because obviously that would contribute to that flywheel that you just mentioned. But I think Dan and Mert honestly would do this conversation 10x more justice. So we'll be sure to link to the most recent Lightspeed podcast, which I know they talked about this in depth. So we'll do that. But outside of that, Matt, why don't I kick it over to you for your hot seat or cool throne?
Yeah, so I don't even know who exactly to hold in the hot seat, so I'm just going to hold this entire situation in the hot seat. It's the MakerDAO-Aave debacle. You might have seen some of it on Twitter. For some context, MakerDAO put up a proposal to extend a credit line of 600 million to basically collateralize DAI with SUSD. So this is taking $600 million that doesn't exist in DAI, purchasing SUSD, and receiving the yield that Ethena USD receives. So yeah, this is a big risk to the protocol, but at the end of the day, it's a risk that pays off and that they think is a worthwhile risk. Directly after this MakerDAO proposal, Aave, or Mark Zeller from Aave, who leads Aave Chan, put up a proposal to delist DAI as a collateral asset on Aave. So set the LTV to 0. You can't use Aave. You can't use DAI to take out loans on Aave anymore. Is the proposal that he put up, and it started a huge controversy. There are, his Mark Zeller and backed by Stani kind of say that the reason for this was risk optimization. They think that DAI's risk went extremely the risk matrices on DAI changed completely in one day, so they want to get rid of it completely. Others are saying that setting a 0% LTV is a drastic measure and that it's basically just severing the relationship between MakerDAO and Aave, which kind of makes sense given that they're starting to compete a little more and more these days. But overall, the whole situation is just a giant shit show. It's kind of setting a new equilibrium for governance across the board. And yeah, it's just probably not a good look for the space overall as it decreases kind of the DeFi Lego composability value proposition that we love and enjoy.
I think historically, like MakerDAO has been, I mean, like it's always been like relatively back, but they've dabbled in RWAs a lot more, and they've extended quote unquote like private credit lines to various like credit managers, so to say. I don't think like SUSDE increases the risk of DAI being unbacked by that much, to be honest. And if anything, like SUSDE quote unquote going wrong would be like a slow unwind rather than just one day like a borrower from a credit fund saying like, hey, I can't repay like this $50 million loan. Um, so in that sense, like I still think it's fine. And from Aave's perspective, obviously there are some sort of incentives that they have to Aave has its own stable coin Go, which I don't think has seen as much adoption as they would like. So it would make sense for them to, delist like a DAI market, or like try to quote unquote like FUD another like stable coin. But yeah, would agree that like it is a shit show, and it brings up an interesting point, right? Like there are these like new crypto / DeFi primitives that people have thought of. They've quickly found like product market fit and grown to like billions and billions of dollars of like TVL or like AUM or liquidity. And at the end of the day, the whole thing about crypto is sort of like DeFi Legos, right? You get this vision of composability, but then now you have these centralized or quote unquote centralized like risk managers coming in and kind of like cutting out the composability component of crypto. And whether that should be allowed is a very good question. And the follow-up question to that is like, who should that sort of risk management lie on? Should it be on Ethena, and they should be the ones actively going like, okay, like MakerDAO shit out, like let's only do like $300 million of like DAI credit for like SUSDE or USDE? Or should that just be like purely on MakerDAO? And then obviously there's like a whole bunch of second order effects to that with all of these protocols that are integrating like all of these different tokens.
In my opinion, it should definitely be a MakerDAO. I think why this has gotten so much attention within the Maker community is because like historically Maker hasn't really made these or a similar sized bet before, especially on a mechanism that hasn't yet been proven in a black swan event. And that's tough to model out because you're basically just assuming like certain probabilities for the black swan event, and then based on that you get some EV calculation and then decide to do it or not. So I know some community members weren't too happy about like, this is a great opportunity for Maker to print a lot of cash because basically the last time I checked, I think Maker was earning 80% APYs for like the DAI borrowed out, which is amazing if you have like 500 or a billion there. So I do see the temptation to, expand quickly and kind of take advantage of these high funding rates we have right now. But then again, on the other side, like if something happens to go wrong connected to Ethena, I feel that it's gonna be like a super quick unwinding or like an event that you either lose everything or almost everything, or then you survive. So it's a tough situation to be in, and interesting decision to go ahead with such a large decision.
Yeah. I mean, I'm all for it. I think while funding rates are positive, like go for it, and then you can change parameters down the line if you need to. But I'm also like a USDE bull. I think democratizing that trade is a really cool idea and a new primitive that we haven't seen, and I'm all for it. But maybe that's just because Ren and I spoke with Guy just this morning for an interview episode, so recency bias.
No, I mean, I do see the vision, and I think it's a great project. It's just that, as always with stablecoins, like the worst thing is when the market loses confidence in the protocol or the whatever stablecoin you have, because usually it's also quite irrational. Like what happened with USDC, where the peg was trading below like the confirmed collateral value that the bank still had beginning of last year, I think. And a similar situation could go down with DAI, and you also have this game theoretical situation where like you're incentivized to front run all of your capital out of the project to be the first one to like not take a haircut, and then the people who are slower are gonna be the ones that are basically left holding the bags. And maybe to clarify, after having said all of that, I'm not saying anything of this is gonna happen. I'm just like trying to paint a picture of what maybe the worst situation that could happen would be here.
Athena's definitely got lots of risks. Like there's the risk that Steth depegs. There's the risk that Copper Clearloop has 4-hour settlement. So even if one of the exchanges goes down, like they'll have directional exposure for a 4-hour period of time. Binance doesn't actually use Copper Clear Loop. So if Binance goes down, but at that point, there's, a lot more to worry about than just Ethena. There's the risk that, the whoever controls the ability to access the custody with Copper Clear Loop actually just takes the money out. There's no contractual obligations, like that could happen, a quote unquote rug. I don't think that it's at all likely, but it's a possibility. So like there's all these risks to consider, but I do actually think that, at least from my perspective and in my opinion, like those risks are outweighed by the current reward that Athena's paying out, at least for me and only for me, not speaking for other people. So maybe MakerDAO made a similar decision and, decided that $600 million was an appropriate risk to take on, given the expected value of their payoff from this position. So overall, like, I'm for it too. I think it's a risk, but it's a well thought through risk.
Yeah, I thought it was interesting that Guy told us today, like, he wouldn't be opposed to moving some of the short legs on the ETH trade into stables, given the opportunity and like the risk management deems that at a certain time. Like, I just think that there's a lot more things they can do to protect against these risks than people are giving them credit for. And I also think like they're diversifying their, their exchanges, their custody providers, like all of that different stuff. So like worst case scenario in my view isn't like really the risk of negative funding. It's actually like the risk of a centralized exchange going insolvent and not getting paid out on the short leg. But even then, like if you've only got 20% of your open interest on one exchange, then you're taking like what, 20% of the 50% of the hedge, and then that's only that. It just ends up being a very small amount. So I don't think this is a scenario like UST where all of a sudden you wake up one morning and your life savings is gone. I think it's going to be at worst like 10 to 20% haircut, but I'll probably eat those words in a bear market, so tread carefully.
No, but as I said earlier, like there's still the possibility that everybody starts panicking and then the situation becomes worse than it otherwise would. One question I had, and I don't know if you want to save this for the other podcast episode, but like, did you talk at all about the insurance fund? Like, what's the situation with that? Has it been growing, and like through which ways?
Yeah, it's gotten really big actually. So they're adding about $6 million a week as of April 2nd. It's up to 33 million from the starting point of 2 million. I believe 10 million of that was added through the recent raise that they had, but I think 20 to 25 million is organic just growth. And I believe that revenue, I actually didn't ask this directly because it was one of my questions. I wasn't sure where the accrual actually came from, but it sounded like SUSDE stakers get their pro rata share dependent upon, how much of the USDE supply is staked, and the remainder. So the USDE that's just sitting in EOAs that isn't staked in SUSDE, that excess goes to the insurance fund. So yes, at 30, 40, 50, 60% funding rates, they are absolutely printing on that insurance fund. I will note that the original studies done by, I believe it was Gauntlet or Chaos, I can't recall which entity, but they recommended $30 million of capital in the insurance fund for every $1 billion of USDE supply. And obviously USDE has about 2 billion of supply and only 33 million in the insurance fund. So right now that actually is below the targeted threshold that was done by a third party, but the internal testing that was done by the Ethena team suggested more like 15 million for every 1 billion of USDE supply. So it depends on which source you want to go on. I think probably taking the more conservative of the two is the better approach, but nonetheless, like at this run rate, like they're going to be at 60 million for their 2 billion USDE in just a couple weeks. And I mean, at that point though, it's a game of catch up because I'm sure the USDE supply is on a fast track to 5 billion, given that their SATS campaign is KPI based and time duration based. So it's either first to 5 billion USDE supply or in 6 months, whichever comes first. And if it's anything like the first campaign, then it will be a lot sooner than 6 months.
All right. I think that's a good point to throw it over to my hot seat, Kutron. Similar on sort of like the private credit side of things, I have Goldfinch in the hot seat. So there was another default on Goldfinch last week, this time from a company called Lend East. They just reviewed that they can only repay 4.25 million out of their 10.15 million loan from the Goldfinch pool. So that represents roughly a 58% loss on that specific loan, and it represents 7.7% of active loans on Goldfinch. According to sort of community members within the Discord, $750,000 borrowed from Goldfinch was used by lendees to repay other borrowers. Obviously, in breach of the loan agreement, you can't really do that. That's a big no-no. And yeah, it was like a 10.15 million loan with a 25-month term, paying out a 17% rate. And yeah, I think like this is probably the third default that Goldfinch has experienced previously. They had a default from Tagunde, one from Stratos, and a few like Alma Vespus added together is probably around like 20 million or so. So Goldfinch is in a pretty rough shape, and all of these private credit protocols have just been continued to be battered, like ever since sort of like the Luna 3AC FTX fallout. And if you would remember, there were like a huge amount of crypto market makers that blew up and weren't able to repay their private credit loans from protocols such as like Maple Finance. And it just seems like that fallout continues though, even outside of crypto borrowers. Um, yeah, I'm not sure what the solution here is. Obviously, like underwriting junk bonds, especially in emerging markets, is pretty hard, and defaults are unavoidable. Like it'll be hard to run a private credit fund with like a 0% default rate, but obviously you're hoping that the return from your lending overcomes like whatever default that occurs. And so I don't think like maybe there's a bit of an adverse selection problem, given that a lot of their loans were in like in emerging countries and these sort of like growth mode companies that were doing like bike sharing or whatever. So that definitely like doesn't help. But it's also not like whoever was like underwriting these loans were not professionals. You know, they had like professional like credit fund managers like managing these loans doing the underwriting. But yeah, at the end of the day, there's always going to be like a lack of accountability. Like I underwrote those loans, but like, you know, if something defaults, like it's not really my problem. And similar thing from like a borrower, you know, like if I'm like a random like bike sharing company in Ethiopia and I default, like yeah, like Goldfinch was probably like my last lifeline, and like if I default, then so be it, you know. So yeah, that's just another thing on the Goldfinch and like private credit side of things. But would love to hear if anyone has any thoughts on how we fix this, to be honest, or like if private credit on chain should like even exist.
I think it makes a lot of sense to have private credit on chain, just because of all of the efficiencies you can reach and all of that good stuff. Like I think we've talked about it quite a few times, but to me it's just interesting. Like if you look at private credit funds, just like in the TradFi world, I'm not sure, but if I recall correctly, I think they produce around like 15-20% yields. Default rates are probably below like 5% of the AUM, which even at that point, like somehow sounds super hard to me or high to me. And like compared to this Goldfinch situation, which what did you say, like 20% of the AUM is now under default? That's brutal because like you kind of assume, yeah, you know that private credit and especially emerging markets are a tough business and like riskier than, you know, buying AAA bonds, but still like you basically take no more volatility than investing into equities, and your returns aren't like even close on par with that. So I'm guessing like if these news spread out more, it's gonna be hard for like some of these debt protocols to, you know, attract capital, especially in a bull market like this when, yeah, we just talked about Ethena, but that feels like pretty close to a zero risk, or I guess not zero risk, but much closer to like a zero risk situation than like investing into these super risky, or I guess not super risky, but still risky like debt instruments in emerging markets.
Credit markets has always been the same thing, which is A, assessing creditworthiness, and B, default recourse. So when we like Maple Finance, when it was going through its whole thing back in the 3AC blow up days, it had a ton of defaults. I forget the exact percentage, but it was even more than 20% of AUM, maybe closer to 50. Their only loan recourse was reputational hit. And in a world where, you know, 3AC was blowing up, reputational hit was not good recourse. If I remember correctly, and forgive me if I'm wrong, I haven't looked into Goldfinch in over a year, but they actually have contractual obligation and loan recourse. So I'm curious to see how that actually plays out, and who would go and sue the defaulting borrower. And additionally, like, yeah, It's this is a ridiculously hard space to solve. If we manage to get on-chain credit to truly work, whether it be through digital identities, I've always had this idea that it's some sort of like ZK. So basically your identity and maybe it's like connected to Plaid. So your net worth and all your different assets are tied up into a ZK proof. And then if you default, it's, kind of unraveled to the lender so that they can actually come after you and there's contractual obligations there. So do you think one day we get these on-chain credit markets to work, and it will be what makes, in my opinion, the next step for DeFi, like brings DeFi back into the narrative? But the solutions we have today just are not there. And from a team like Goldfinch, who seems to have transitioned a lot of their bandwidth and brain power kind of into other initiatives of late. So they launched this like AI advisor or something. It'll be interesting to see how the situation plays out. But overall, I'm hopeful. It's a good team. I wish them the best.
I just can't believe that interest rate. You said 17%, Ren. So you're telling me I can buy USDE and stake it and earn 3 times the amount as doing an under collateralized loan as a lender in an emerging market? Like you're on crack. Like under collateralized lending on chain is a great business for borrowers and borrowers only. Like you're insane to be lending on those things. I'm sorry. I think it's a terrible idea until like that's on a private blockchain and like actual like people who have spent entire careers in under collateralized lending and credit assessment, like that's when it makes sense and you can KYC and there's actual default recourse. But otherwise, like that's a no for me, dog.
Yeah, now that you put it that way and make that comparison, it is pretty crazy. I mean, technically, Goldfinch tells that all of its loans are like over collateralized, and they say like they do a bunch of due diligence, like it's collateralized by like balance sheets, like cash flows and whatever. But yeah, I mean, like it's still kind of under collateralized at the end of the day. And if you're gonna make 3 times that on Ethena, which is like quote unquote like real yield, then that seems like a lot better risk reward.
Yeah, I'll add that I don't know anything about Goldfinch for the most part, and I do commend them for like trying it because it is needed. Like DeFi is fundamentally constrained until we have under collateralized lending, but like today, like yeah, no.
You just put that so simply and eloquently. Like, yeah, hard agree.
Yeah, I think one more thing that I just like to put on the cruise drone this weekend has been making waves on CT is Pump.Fun. So Pump.Fun is a website that allows you to launch a shitcoin on both Solana and Blast. And basically how it works is that you deploy a coin, you add like a ticker, your image, whatever, and people can like buy it on Pump.Fun. And once it reaches 69,000 in market cap on Solana, it deploys $12,000 of liquidity into a Radium pool. And basically, as you can imagine, like thousands and thousands of tokens are getting launched there every single day. And every time a token hits the Radium pools, Pump.Fun takes a 2 SOL fixed migration fee. So at current prices, that's probably like around $400. And Pump.Fun is making $350,000 a day. And if you sort of annualize that, that's 100 million in annualized revenue, which is like pretty crazy, to be honest. And like on the other side of the equation, like Dex Screener, they charge like $299 for an ad on like sort of like the right side where you see like the price, the market cap, and like that ad space is always filled up. So I think obviously the main takeaway, at least for me, is that picks and shovels are absolutely eating, especially like meme coin picks and shovels, which makes me think that like Telegram bots will probably have their day again this cycle, given that they've been like pretty battered, to be honest, over the past few months. But it's just crazy seeing like such a simple business make so much money. And like it's something that's like super unique about crypto. And these guys are like a 3-person team.
Yeah, I mean that. So wait, you're saying for the X screener, when somebody links the socials to the coin, they charge $300?
Yeah, so that's one component. Like when someone wants to link socials, they charge $300, and then there's also like ad space which they sell on the sidebar, and that's probably like another like completely guessing here, but probably like another few $100.
That has to be such a good business model because yeah,
Yeah,
basically every coin you look at always has those socials there. And that's so scalable, or like you basically don't have to do anything anymore. You just like you've completed your platform and now you chill and enjoy the bull market. Yeah, I think maybe it doesn't make it sense for these platforms to launch a token themselves, but like shout out to the team for creating this stuff.
Pump.Fun has a real opportunity. Like in its current state, it could definitely be like a, temporary time in the spotlight. But overall, it's a simple idea, right? I'm not sure if Ren mentioned it, but the LP gets locked. So, you basically are buying into this. You're buying into this liquidity curve with Sol. You're buying this meme coin, and then eventually a large portion of the Sol that gets put into the liquidity curve gets put into Radium, and then that LP token is burned, so it's no longer accessible. So it helps with like these fair launches. It removes your risk of in the traditional sense getting rugged, where you take out all the liquidity from the pool. You can still get rugged other ways, but the traditional rug and liquidity sense. So it's like a great idea from my perspective. The actual platform is, has a lot of room for improvement. But that said, like if it goes and launches across all these different chains, right now it's only live on Solana and Blast, but you could easily go see it live on Base and Arbitrum and everywhere else in the near future. There's no reason it shouldn't be live there. Besides, obviously, instead of using Radium, it'd be using Uniswap or whatever. So I think that Pump.Fun actually has like the legs to be a real, like you said, pick and shovel or infrastructure product in crypto. And I definitely kind of hope to see it continue iterating and growing and being better.
Here's a question for you all. If you were one of the 3 co-founders of Pump.Fun, you're making $100 million in annualized revenue today. So that's probably like $33 million each. And chances are like this meme coin like craziness continues for at least like a few more months, if not like until the end of the year, or it gets even crazier from here. Would you launch a token or no? You launch a token and I don't know, like 80% of your revenue has to like go back to like token holders, just like some fee switch. You have to manage the DAO, like just push back. Now you have like community owning like part of the protocol. Whereas like if you don't launch a token, sure, you don't get like whatever money you can cash off the token, but you're making like $33 million each in like just cold hard cash.
If I were them, I would be doing absolutely everything I can to further decentralize the actual product, because you are literally enabling the launching of shitcoins. Like yeah, I would want to distance myself from that personally, and I wouldn't want to just be pocketing revenue into perpetuity. But that's just my take.
Sam wanted to say a 2-word phrase that can't be said on this show so bad. Oh my gosh. Yeah, there's a lot of liability with launching tokens, but I think more so, if I go launch a Pump.Fun competitor today and I shove like just a point system on the top right corner, so that if you launch a coin, you get 10 points, or you launch a coin that successfully hits Radium, you get 10 points. You buy into a coin with more than one Sol, you get 1 point. Like, they will get vampire attacked in 8. So I do think that actually to stay competitive, they probably need to have some sort of token or incentive mechanism for users at some point.
Okay, another interesting question would be, does anybody know if there's really like been a token that's been launched on Pump.Fun and then it's become like huge?
I think Ansem's cat hub or whatever was like a Pump.Fun launch. And then there was this like tweet I saw. I don't know if it's true or not, but like some guy launched like 183 different tokens and he's made like 650K so far. So yeah, I do think there's like been a few like big ones, like not like whiff level big, but like relatively big tokens that have been launched on Pump.Fun.
I'm taking a look right now. It looks like Shark Cat is the most popular at not sure the exact market cap, but maybe 140 million or so, followed by Ansem's Cat Hobbs at 50 million, followed by What in Tarnation Wit at 22 million. So short answer, no, but like those are substantial numbers.
All right, well, I think that's a good place to stop it. I know we all have an eclipse to go watch, other than Brick, who is fading the coolness of the eclipse, which is insanity to me. But you guys can get after him on that in the comments if you disagree as well. But thank you guys so much for coming on. We will see you here next week. And yeah, thank you.
Bye-bye.